that the message that we got from Chair Powell today?
I think so. The inflation numbers have been encouraging of late, but inflation itself still well above the Fed's target rate. If the economy doesn't slow, as we anticipate, falling into a moderate recession by early next year, that could keep inflation above the Fed's target rate, high enough for the Fed to come back in and follow up on Chair Powell's comments that rate increases aren't off the table just yet.
And what about rate cuts? I mean, he pushed back on the idea that those are coming soon. What are your expectations? And do you think market assets are justified in moving the way that they are today?
We think the market's getting a little ahead of itself. We don't see rate cuts until the latter part of 2024. That's predicated on a recession, a moderate one, but a recession nonetheless, by early 2024. That allows the Fed clearly to move to the sidelines if we're right and others are right, that a slowdown in the economy will pull inflation still lower. But that's tomorrow's story, not today.
Gary, what about China? There's lots of measured optimism that at least perhaps we're seeing a bottoming out when it comes to the economy, that we could see more stimulus to come, and that's going to finally make these super low valuations on Chinese equities more compelling. Do you feel something similar to that?
Somewhat. We think bottoming, yes, but struggling to regain momentum, a gradual recovery. We think the degree of stimulus by the People's Bank of China and other authorities in China, the Chinese government, will be constrained a bit by the overhang of debt in the property sector among local governments. And so we're looking for a recovery, but we think it will be fairly drawn out over the next 18 months.
You see broader downside when it comes to US equities, certainly. Are there sort of international pockets where you would seek some diversification?
On the international side, we do see the situation improving, but not until the latter part of next year. We think as the U.S. goes through its own slowdown, Europe already is on the verge of, if not already in a recession. We think that plus the slow recovery in China means that the weakness in world trade will persist. We see the U.S. as being among the stronger performers worldwide. And even though interest rates may not be rising from here, the fact that we don't look for rate cuts while others are closer to that means a strong dollar. And that's disinflationary or deflationary for the global economy.
Are all of those reasons why you prefer developed markets over emerging markets? And how do you position more defensively if you're sort of veering away from risk assets?
Well, we would look at developed markets a bit more positively than emerging markets, but we're still cautious on overseas assets, equities in general. We think the place to be in a defensive strategy, which we advocate given the prospects for a slowdown globally and in the U.S. to some extent, is defensive, which means that we continue to favor the U.S. market. We favor liquidity in large cap stocks. We favor quality, higher quality stocks with the balance sheets that can weather a slowdown, defensive areas of the market whose earnings are less sensitive to the ups and downs of the economy as well. And that carries over to the fixed income market as well.